All right, the markets had a pretty down day today, and kind of a little bit more than the normal volatility. So that's why, like, Brandon's out. He typically does the videos on Thursdays, and when he's out, I usually don't cover for him. But considering today the volatility was a little bit higher than normal, I decided that I would do a video for tonight and kind of talk about the post CPI reaction to what the markets did and some of the patterns that it produced today. We've been kind of we've seen these bullish signals that have cropped up over the past few videos, but with the idea that most likely they were not going to turn into a trend change. So now the question is, like, is that the case now? Is today kind of kind of affirming that view that we were not going to be that bullish, we were not going to just end this with a pullback, that we were indeed going to follow the Russell's lead, which already is in correction, and bring the rest of the broader market into correction as well. So today might be a little bit of a microcosm of what that means on a smaller level of what I expect we'll see on a much bigger level. And I'll break all that down in the video today and show you what all those signals are that did crop up today, and what, how the major assets move, because there was significant moves in the dollar and bonds that had a pretty big impact on things, and we'll talk about whether or not it's a one-day phenomenon or whether we just had the 3-4 day phenomenon and now we're back to the trend that we had before that. And then our trade idea is a stock that broke down a lot harder than what the market did, and we'll talk about how to trade that, if kind of with the idea of if the market does this is an example of how we can trade that. So let's go ahead and get started. Today is Thursday, October the 12th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we go too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website on MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, check out some of these other things over here on the right, including our Market Outlook live video I do at 3:30 Eastern time. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click that thumbs up icon and it opens up this tab. Hit that like button. I don't know why it didn't come up. When you click on that, it should come up with the actual post itself. And yeah, there it is. And you click that like button. Again, the more you do that, it helps get our content out here to all of our followers on those platforms. That's why we always ask. Our goal is to get to 100. We didn't quite get there, got in the 70s again this time. So thank you to those who do like this day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator, and you can see a little bit of a reversal. It was nice to finish off the lows of the day. Actually ended up getting above yesterday's low points. That was a relatively decent sign for the markets. The intermediate line did cross above market sentiment. We talked about this. I can't remember if I talked about it with you on these videos or not. It's better to have, at least a bear tag, if not closer to like full-on dark green shading and a green line when you get the crossover, like over here, for example, on that intermediate line above market sentiment. So, I mean, nothing's 100% technical analysis. You hear me say that all the time. So there's nothing that we can say, okay, this crossover is going to work and this crossover is going to fail. But that is one sign that will increase the odds of it actually working, is if you at least have a bear tag, if not your dark green shading and green line by the time you get that crossover. So we have neither, right? We got the bear tag earlier this morning. I tweeted that out there, in fact, when we were at the bear tag, but we didn't finish with it because, as I tweeted out, the Russell was hammered already by the time the S&P, and so the S&P ended up just following suit with what the Russell did. The near-term line actually was, at the lows of the day, the near-term line was like closer to the lower half of the chart, like closer crossing below the intermediate line. It didn't because of that rally late. But still, it's out of the reversal zone. So it's still in bullish territory. The momentum line avoided finishing at extreme lows. In fact, it didn't even get into the oversold levels. So, I mean, that was a really good save at the end of the day today. And that might be enough to save us from a complete reversal here, kind of similar to what we saw with some of these other reversals coming off of these bear tag type, moves back to the moving average. I mean, we were obviously a lot lower from the moving average than we were over here, and we made a move up to it, and this one you couldn't even get through it. The last time the near-term line got into bullish territory like this, we did get above the 30-day moving average. So not the case right now. As of right now, we did not close below the low point there. So again, might end up being what saves us. That's not the case for the Russell 2000. The Russell 2000, we wiped out all of, pretty much. We ended last week at 1731, and right now we're at 1734. So and at the lows of the day, we did more than wipe out all of this week's gains or these 3 days gains there from last Friday, Monday, and then Tuesday. That's how big of a move. The near-term line did drop out of bearish territory and did drop into the lower half of the chart. You can see the momentum line did drop into the reversal zone. Your intermediate line is actually slightly rising, was actually slightly falling when we were at the lows of the day. So that's how sensitive that was. So most likely can turn lower tomorrow if we don't really rebound in the big way. Your market sentiment line is falling. They're both barely above the 20th percentile. And the fact that we've already come out of bullish territory already it makes it hard for the intermediate line to get going if the near-term line can't stay at bullish levels. Doesn't have to stay necessarily in the reversal zone. It'd be nice, but at least has to stay at bullish levels, at least in the upper half of the chart, and that's just not the case. You have light green shading, so we don't have dark pink shading, but again, that's you probably will tomorrow unless we get a significant move. Now, see, that's a 2% down day for the Russell. The NASDAQ did not fall down nearly that much. It was only down 1/3%. So the NASDAQ continues to actually, you've actually got dark green shading right now in the NASDAQ. You don't have the green line, so the moving average isn't rising. It's still falling. That's why it's yellow. And you're barely out of the reversal zone on the near-term line. In fact, you could argue that this is actually a pretty bullish signal, like an oversold momentum line with a rising rising intermediate line that's at least in the upper half of the chart. That's actually a pretty good bullish signal. Again, the intermediate line did cross market sentiment. Again, it'd be better if you had a bear tag. We got the bear tag the next day. Dark green shading a green line. We might be a day away from that, depending upon how bullish we are tomorrow. If we do bounce off of this. That near-term, the intermediate line is between 20 and 80. So if that near-term line crosses back below it, then we have a pretty decent indication that this might be the end of this little short-term wave higher that we have right now. So really important to close to the week over the next 2 days to see how we end up closing this week. Let's take a look at the long-term chart, that weekly chart on the S&P that we've been watching. That's a kind of transition. We kind of really would like to see a green arrow form here, ideally on this transition, if not the week after, right? When you get the transition, you get the green arrow in the week after. So, the problem now is with this decline that we're actually further away from that green arrow. We have to actually close above 43.74, and now we're at 43.49. So it makes it unlikely, but that's the magic number, 43.74, that we need to close above in the next 2 days to get that green arrow and feel pretty good. Obviously, like I said, when you have a transition with a really strong bullish candle, then you can feel really good about the transition actually transitioning to a bullish move. But if that candle ends up being a doji pattern, just like the Hakinyashi, then you're most likely going to get another transition candle or continue the move that you had going into it, which in this case would be bearish. And again, that 40-week moving average, the Russell has easily closed below that 40-week. The Dow Jones Industrial Average, as you can see, is also below, even with this higher low point that we got. And as of right now, a higher close and a higher low point. The NASDAQ, excuse me. The NASDAQ does have, at least did have the green arrow at the highs of the day. Oh, there it is. Yeah. So the NASDAQ does have the green arrow, is more bullish here. And you can see is easily above the 40 weeks. So we're nowhere near it. So that's, and back above this 23% retracement. So the NASDAQ is kind of showing what we want the S&P to look like. That's kind of the pattern we like to see to really kind of confirm that you can see it here too. Like the Nasdaq's got 3 green arrows. You've had 3 green arrows now for 3 days in a row. If the S&P had this kind of pattern, we'd feel really good about it. We'd feel much better if the line would turn green and our histogram wasn't falling, but still, this is better than what the other indexes are showing, which are 2 green arrows and a falling histogram. And the Russell actually close to getting 3 red arrows if we follow through on this decline today with some more weakness. So that's the pattern we like to see that we're just not seeing, and you can see it on the 2-line version. We're stuck. The S&P is stuck between moving averages here, between the 200 and the 30 and the 50. This is where failed pullback bounces tend to fail in this level, especially with that point of control. Now, again, remember, the Q's broke. So if the S&P had done this, we'd feel good. We're above the point of control and above these lines, but the S&P did not do this. It's the Magnificent Seven, which make up over 50% of the Qs. They're, as well as they're helping this, but we're not. Look at IWM, which is a dramatic difference, like way below the 200-day moving average, below the point of control, and now again flirting with the low end of the value area on the 1-year chart. And now you're actually pretty darn close to a death cross, because your 50-day is that close to crossing below the 200-day. So that's how close we are to. We already got it on those exponential weekly moving averages, and you're about to get it here too. So again, and as I mentioned to you before too, on the weekly chart, look, that's the kind of candle we can't get on the S&P for the week. The MACD is clearly negative. Stochastics is way into oversold levels. Your 8 and 17 week are crossing below the 30 week. It's a clear downward trend that you see on IWM that we are flirting with seeing on the S&P, right? As of right now, we're holding up, but we're not back above the 17-day. And as I mentioned to you before, the week that we get the bear tag on the S&P 500, the week that we get that bear tag on the weekly, let me show this again. The weekly chart here, it generally coincides with like here and over here. You see that one there. It coincides with significant weekly declines that we haven't had. Like, we've had some pretty sharp declines. We had some declines, but not significant, right? On IWM, we haven't had that 3% move, or excuse me, on SPY, sorry, which is where we'd really want to see it. We've had. Last week was a bullish week. The week before that, we came close there on the 18th, but on that week of September the 18th, going back to the market forecast, where we had close to a 3% decline, we were still right there. We didn't get that bear tag yet, and it wasn't. 3% is the minimum, and that was like a bare minimum, and we were barely below that. So that kind of decline or worse, as you can see over here again, that's the kind of decline that you typically fall through that level with. And considering that we've been avoiding it for these past 3 weeks here, while getting a bear tag throughout the week, just not finishing with it, suggests that when we do get it, it's probably going to not be very comfortable. And we're kind of setting up for it, especially with the intermediate line working its way down towards market sentiment and that close to crossing below market. A 3% move or more, 4 or 5, because these are well more than 3%. Then that would get your intermediate line down. Probably would also be a failure of that near-term momentum line without crossing back above the intermediate, and we would be clearly below the moving average. Looking for that move of 2.5% or more to suggest that we would stay below this average for a while. And that's what corrections are, when you're below this 30-week moving average for a while. Pullbacks just get you to it. Corrections get you through it and stay below it. Let's look at some of the other oscillators. They also confirm that we're not bouncing here. As you can see, the positive and negative DMIs are both below 25, so there's no clear trend developed yet. Again, not necessarily the case for IWM, as the negative indicator is right back above 30, positives back below 20, so that's a clear change back into what we want, what we don't want to see on the S&P, we are back below 50. We are above 100, but we need to be, we need to get that. We need to be above 100 for a while to get this above zero, and we're clearly not there yet on the weekly basis. So we're still struggling there. The Russell 2000, of course, is back below 40, back to bearish levels, and again back below zero. And you can see its weekly CCI has been below 100 for a few weeks too, and not getting above it. Looking at the the Ichimoku cloud, you can see there we did finally hit zero on the S&P on the trend quality and noise balance. So the trend that we had is over. The bearish trend that we had is over according to those indicators. Now, as you can see, we can just restart a new one. In fact, that's what's happened. The last time we hit zero, we just restarted a new one, just like that. So that's still a possibility, considering you still have a negative rate of change. You're still below the, and we're back below the blue line. And also considering the IWM did not drop back below zero. In fact, got right back up to extremes, right back below -5, back above 80. That's a mature bearish move. We've looked at this before too. You can see we have not started a decline yet, a trend on the weekly chart. So that's why I say we may very well just be getting started here. I think I talked about that a few weeks ago. The last week was a week that the bullish trend ended on the weekly chart, and then now, like I said, when that ends is when you start to worry about corrections beginning. Looking at the Bollinger Bands, we talked about yesterday getting in the upper half. We're actually still in the upper half, just barely, of a declining bandwidth that now is not very strong. Your momentum is still waning here. The bands are still outside the Keltners, though they're moving in pretty rapidly. So it doesn't look like they might not stay outside the Keltners for very much longer. It will be dependent upon where we finish relative to, like, if we get back into this lower quartile again. Again, looking at IWM, we are back into that lower quartile. We never did get in the upper half. We are back in the lower quartile, which will slow down the momentum. It didn't get it back to a red bar down here, so it's not, the momentum is not going back to a new low yet, at least. But at least it is going to slow down that move of the bands to get inside the Keltners, which is what turns these red and signals the potential for a change in momentum from from the current trend to the opposite. So in this case, the current trend's bearish. So the opposite would be, when these blue bars come in. They usually happen when you get these reds. Now, the last two times it didn't, right? The last two times we came down, and instead of going bearish here, we bounced back up and stayed higher. This time we came down, we bounced up, and looking like we're going to change the trend, and we didn't. We came back down again. And so, are we going to get that kind of move again? It's not very common to get these, but you can see, it's more common to get the change that goes through the red, right? It goes through the red with the change, goes through the red with the change, goes through the red with the change, and then there's no momentum because you can't get the green dots until you got a strong momentum move there, and then you got them green. But you get the point, right? Especially with IWM being below the Keltner as often as it is. SPY also, for that matter, also being below that lower Keltner channel for as often as it was, suggests that, it can be it's not just a one-day phenomenon that suggests how oversold we are. It seems to be more of a trending thing. So that's why I think there's more likely we continue lower on that move. Looking at today, so here's the saving thing. Here's why today might not be nearly as bad, is because as bad as it looked for a while there, we held last week's high for a bounce, and we bounced up back up above yesterday's low point. So we got a higher high and a lower low, but we didn't close below the low. We closed back above it. So it's not the most bullish pattern, right? It's not bullish, but it's also not that bearish either. And that the fact that last week's high held is a very, very good sign for SPY. Again, looking at the alternative here, we did get a lower high, we did get a lower low. Monday's low point, right? We've been talking about how Monday either sets the low or the high for the week. Obviously, this week we have been trading. Tuesday we got above Monday's high, so it's very good. So the probabilities were that Monday set the low for this week. So the Russell 2000 got below and actually held the low on the rebound. So that's suggests that might be where we ultimately see. I think I said in the video on Monday, but I definitely said it in class the past 2 days. My expectations for SPY, like I've told you about this Arun indicator, right, and how it's set up for, you see as that red line's drop below 70, it's set up for a reversal, right, a reverse for the green line to hit 100. So it's set up for that to happen. When the green line hits 0 and the red line drops below 70, you're set up for a new 4-week high point. That's what that signal tells you. And you can see this high point is going to move to here, then it's going to move to there, and then it's going to move to there, and then it's really going to drop, right? Because after these, 1, 2, 3, 4 more days, this is going to be the high point, right? This one is going to be the 4-week high point. So, so my in the next 4 days, I would expect we'll more likely get a new low point than we would to get a new 4-week high point. Even though like breaking above, this week's highs would really set us off to the upside. But considering what we just saw with IWM, more likely it's going to be the other way around. It shows how important these next 2 days are. We would really like to see things obviously rebound instead of what we saw today. The range was bigger than average, right? Remember yesterday was smaller. The day before that wasn't very big either. It got even smaller yesterday. So these were below average ranges. But today it got above average and the volume picked back up again. So probably not the greatest thing to see a day like yesterday going into the CPI, where we had really small range and really small volume, to picking back up with the range and the volume on a down day today. We'd like to really bust through that moving average with a good strong up day and with a good volume, ideally maybe even with a gap, like a runaway gap or a breakaway gap, and then we can feel really good about bullishness. But considering how we petered out as we rallied and now we're picking back up as we're falling, suggests, especially with IWM. I mean, IWM had a huge range today. Let's see here, the range was 5 points and the average is 2.83. So big range, and when we look at the volume here for IWM, down here in the bottom right corner, you can see, above average volume, not quite, an arrow, but above average, 38 million there. So when you look at it on this chart, the volume here at 38 million is back up into here. So that's a pretty decent amount of volume and range that suggests that, in fact, the ATR right now is at its highest level on an average basis since way back over here, right? So when we were coming off of that peak. So, we are clearly trending higher on the average for IWM, and that's not a good pattern to see, and again, would suggest more weakness ahead. The VIX rallied today, but did not go up very much. You're still in neutral levels. We were at it's pretty low levels. Like for the last couple of weeks, I know it was actually lower on the absolute basis too. But especially here, hitting that 90. When you're above these lines, there's support. When you're below these lines, there's resistance. So we actually made a round trip. Excuse me, between 90% and 95% before pulling back late. The other kind of good sign that things may not be that bad today was the fact that the VVIX didn't go up very much either. So that's a good sign. The VVIX is actually still below 100, and it's at 91.87. If that starts to go back up above 100 again, and even higher, because that's where you're, getting up to like 115 is the concern, and that's what I would expect. If we can kind of drop back down into the 80s, then that would be a sign that this pullback is over. And the market's, at least the market's not expecting that much more of weakness ahead, and hence not looking for as much protection now as what they were here earlier when we were kind of washing out and peaking on the VIX. When you look at what's driving the action today, you can see, it was right back to what it has been, right? We had the CPI report. It came in a little bit hotter than expected. Not very much hotter, but enough that it kind of spooked the markets a little bit. And we went right back to the three-headed monster, right? Strong dollar, commodities, at least outperforming, if not up. It wasn't up by the end of the day, but and you can see TLT, and you can see the Qs act as a safe haven. The Qs were up, IWM was down 2%. So when you look at the ratio here of the Qs to IWM, let's pull that chart up here. Actually looking at the international stocks relative to US, but here is the Qs relative to IWM, and let's go back to the daily chart. You can see that it really spiked, right? Like, let's go 1 year chart. It jumped up big time today. Now, last few times that we've had some big jumps after being bullish, we've had some big jumps higher. You notice it kind of just went sideways. But you also notice that the correlation at the time was, in this case, positive, but kind of flat. Then we had a big jump up here. And then again, you can see how it just went sideways. But in this case, the correlation was strongly positive. So the market just kind of settled down. Over here, we're getting a big jump again after being bullish for a period of time. MACD is up pretty high. So the CCI is up pretty high, diverging. The negative indicators actually at its lowest levels it's been in a while there. RSI back above 70. So this is a pretty decent high point here. And then you got this big gap higher. But in this case, the correlation is strongly negative, and that's not normal. And eventually, this is going to turn back to being positive where it is normal. And when it turns back to being positive, I mean, over here, the best case scenario, when it was already positive, was that it went flat. Well, if this turns back up from extreme highs, then, in both of these ratios and the markets start moving in the same direction, the market's already in pullback mode, flirting with correction mode. It very well could be what tips us from pullback mode into correction. Remember, correction mode, getting below the 200-day moving average, getting below that 30-week moving average for an extended period of time. And so that might very well be what tips us over. This is kind of like an exhaustion type gap on a ratio chart. So take it for what it's worth. But this is, as we've seen, when you've already been pretty bullish with all these indicators kind of giving you an idea, and we're already there again, especially kind of considering that, we haven't been this high on this ratio since 2000, since September of 2000, then, that kind of screams to me that we might be a little far-fetched here. You can see the long-term PPO is really, really high. If you look at the PPO of just where we are relative to that 50-day moving average on the ratio chart, here you can see that's what this chart is. Again, we're not as high as these two periods, but we're still pretty darn high, to get up to this level. And that, like I said, not quite as high as that peak, and definitely not quite as high as that peak. But still, this is, we're pretty darn high here and pretty overbought as it is, that I'm concerned about what this can say. And it's had its impact on the breadth indicators. Look how we already fell back below 150. To 100. Now we're not below the moving average, but we had a pretty significant decline there on a one-day basis. Looking at the new highs and new lows, you can see here, let me zoom in on that so we can see it. You can see we came all the way back down. We were looking pretty good. Came all the way back down below the minus 435, so right to the moving average. You can also see from the McClellan oscillator, we are already, after a couple of days close to there, it's almost following the same pattern that we saw here at the beginning of September, where we were kind of bullish and looking like we might break out, and then nothing. And it's almost looking very similar again. In this case, we are flirting with getting below zero, and we were trying to get back above zero with that move. Now we're breaking below 500, trying to get back above 500 with this move. And if we don't, then, again, that's another sign of correction when we are clearly below minus 500 like that. You don't get below minus 500 on this when you're just in pullback mode, right? It only happens in the corrections, and usually in the worst of the corrections. But even over here, it only happens during corrections when you get to this minus 500 level, 15, 16. A little bit there in 2014 with the Ebola virus kind of getting really bad. And then 2012 before QE3. But there's 2011, there's 2010. Those are when we're below minus 500, it's more than just a pullback, generally speaking. As we again notice, remember the Russell 2000 is in correction mode, and you can see that too on this chart. When you look at the 12 grid for the different sectors, I mean, like XLC looks good. I mean, it's dark green shading and a green line. So that, I mean, we were in a yellow line at the lows of the day, so it's back to green. I mean, that's great. It's above 80 on the intermediate line. The XLK is dark green shading and rising intermediate line above 50. It doesn't have a green line, but it's yellow at least. Everything else is red lines and dark pink shading in XLP. Like these are all, I mean, these are all very indicative of kind of like U.S. centric, economy versus XLK, XLY, XLC, which are pretty much all Magnificent Seven, and they're not as sensitive to U.S. economic expectations and more so kind of their own economies. I mean, a lot of these companies have pretty much are their own economies relative to some of the smaller countries that are out there. Speaking of that, when you look at the different countries, especially the big ones, right? All the big countries here, we'll look at the 12 grid for all the bigger economies. Russia's still included in there, but that ETF isn't trading anymore. Again, you can see, I mean, we have light green shading and red line across the board. So it was a nice little rally, but it wasn't a trend-changing rally as of right now. And I mentioned to you before, corrections have up days. I know it's kind of weird. It's kind of weird that when we're bearish, we just don't go down every day until we're done. I mean, you go down, you go, and you have up days. You have up weeks during corrections. That's if there's one lesson you learn from this chart here that I always bring up, and I'll zoom out so we can include the bullish trend and the correction of 2022, and then the bullish market of 2023, is that there are plenty of green bars during a correction. There are plenty of red bars during a bull market, right? And so same thing here when you look at it on a weekly basis. So here is there's COVID, and then here's the correction. There's plenty of green bars. In fact, you actually kind of have your biggest bullish moves when you're in pullbacks and corrections and bear market. I mean, that's when the green bars are the biggest. They get smaller as you get into bullish trends. And of course, when you're in bullish trends, you do have some red weeks. So you're going to have green bars like we've had last week on a weekly basis, and how we've had over the last so many days on a daily basis. But that doesn't mean that we've changed the trend, and that's kind of what I'm expecting. Is it was nice while it lasted here, and we're probably going to start going back to having some more down days. I mean, we still haven't really had a 2% down day. We didn't have one to start this off, and we won't because we've started it off. But you probably can't end it without one, right? You can't end it without a washout move where that VIX jumps up. We get a 2-3% down day and washes out all of this bearish sentiment, and then we can bounce, right? So, again, when you look at it from, the last correction, and if this is indeed a correction, the last correction did start with a 2% decline, right? So you easily had some bearish declines here. And again, you had some pretty strong bullish moves during the correction, but you easily had some. But you can see when we hit lows, those were some of your bigger candles, right? And then there's your October lows over here. Like when we were at the lows, we had the bigger down days, and then we followed those up with some pretty good up days coming off of those lows. You can see some pretty good up days of 3% or more on a lot of these bases here. All right, our trade idea today is on ISRG. You can see dark pink shading and a red line. We broke below like these recent lows today, big time, breaking below the 62% retracement of this late rally up to this peak. Of course, we had that divergent peak up here with the cluster, but I mean, that's a pretty significant breakdown if I were to change this back to where we had it. It's kind of flirting around with that divergent high point there. But here's the ultimate high point, and you can see even then breaking below that 62% retracement, setting us up for 100% retracement, right down to 222. You can see big PPO. I mean, we are way below the moving average, 10% below the moving average. We've almost got a cluster. In fact, the intermediate line was at 21. Short-term sentiment, which was kind of bullish, like everything else, not so bullish the past couple of days. So big drop there. You can look at it on the weekly chart. Here you can see eventually the break that we've had this week below the 40-week moving average, right? That tends to lead to more weakness here. So that's a bearish sign that we haven't seen yet. That would obviously also lead to what would be potentially a death cross as the 50-day eventually crosses below the 200-day. We broke below the 200-day now, clearly negative MACD, big volume the past couple of days. Looking at like the RSI and the CCI, you can see big time breakout move, almost below 30 there, but way down below 200. So big breakout move there. The DMI, you can see a big breakout pattern on that as well, above 30, below 20 easily there. Looking at the Ichimoku cloud, we are developing a intermediate trend strength just like that, way below the cloud. We never did get the green crossover there. Looking at the Keltner channels, I mean, we busted down through both those, the lower band, way below the lower band, and the lower Keltner channel. We'll be below that lower, with the momentum starting to pick up again. I mean, and the bands haven't moved outside the Keltner channels yet, so we're about to get green dots again. So I mean, we might just be getting started here. But that's a big move. So what I decided to do here, instead of like going for like a strong directional trade to the downside, I decided just to do a bear call spread. Try to get that same $500 reward, a little bit bigger risk. I'm not as worried about the upside. I'm just worried about how much downside we might get in the near term. The nice thing about bear call spreads too is with this much time left that we might be able to actually get 50% of this max gain early and then free up that $1,000 for another trade somewhere else and try to take advantage of the sharp movement volatility that we're seeing. Because remember, calls lose their value very quickly when you get some big movements fast. So that's kind of the idea behind this trade. So let's go ahead and right click and we'll send that trade through. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all next time.